Dive deep into the world of finance and economics with this comprehensive video course. Whether you want to make smarter investment decisions or you're looking to grasp the intricacies of global economies, this course lays a great foundation. The course combines theory with practical insights, paving the way for you to navigate the financial realm with confidence. Sriram originally taught this course in person and now has put together an excellent video course on these important topics. Hello everyone. Today I'll be taking you through this course on economics and finance and how they're relevant for businesses. Throughout this course, we'll be learning a variety of topics, starting with the key concepts for business, capital markets, valuation of stocks, business strategies and financial statements, how to analyze these financial statements, and things like capital budgeting and cash flow. We'll also discuss things like the business cycle and industry analysis, ESG, macroeconomics, portfolio diversification, and alternative investment types. Throughout this course, you'll learn a variety of different topics in all three of these disciplines and understand the interconnected nature of economics, finance, and business. In this world, I also have a YouTube channel called Changemakers Media, which you can see in the comments. I would greatly appreciate it if you guys could subscribe there. I share stories on how teens are making an impact in the world and how you can go ahead and support them. Welcome to the first class on economics and finance. So a thought experiment to start. Imagine you had a magic box and it outputs $1 a day or $5 or $20, how much ever you want, and it runs forever. How much would you pay for this box? Some people say $1 million, some people say $1 billion. Well, let's look at it from a statistical standpoint. Instead of a box, let's imagine we have a savings account and it gives you 1.05% interest annually. The following question is posed for consideration. What is the minimum amount that must be deposited in a savings account in order to generate a daily return of $1? It is evident that, utilizing Excel, the principal or the original amount that would need to be invested is $34,761. This is a substantial amount, and justifiably so. This is attributable to the nominal interest rate received on our savings account. The following example will illustrate this point. To provide an example, if an individual wishes to purchase a house with a market price of $100,000, they would require a deposit of $100,000. The subject contributes $20,000 towards the initial payment, and subsequently takes out a mortgage of $80,000, which is a loan. The financial implications of extricating oneself from a mortgage arrangement are of particular interest. To this end, the amount of financial remuneration required to accomplish such a task is of relevance. It is reasonable to hypothesize that an annual contribution of $9,396 would enable the mortgage to be paid off within a period of approximately 8 or 9 years. However, the actual timeframe is 20 years, which can be attributed to the mortgage interest rate of 10% that has been applied. An examination of the data reveals that, over the period under consideration, the balance or the principal decreased by approximately $1,400 between 2019 and 2020. The rationale behind this phenomenon is that the majority of the $9,000 financial contribution is being allocated towards the settlement of mortgage-related interest expenses. This phenomenon is anticipated to persist throughout the duration of the financial contributions. Nevertheless, this effect is mitigated, as the magnitude of the principal diminishes and our interest payments decrease. The following key concepts will be explored in today's class. The concepts of return on investment, time value of money and net present value are all important factors to consider. Therefore, the decision must be made as to whether the preference is for a return of $1,000 or 25% on an investment. A comparison between the two is not possible. The provenance of the apple and the toe. So, what is ROI? ROI is a tool that facilitates the comparison of the efficiency of one investment with that of another, thereby enabling the user to draw parallels between disparate entities. Return on investment, ROI, is a metric used to evaluate the effectiveness of an investment by calculating the relationship between the return generated and the amount of capital invested. The following formula is used to calculate return on investment. The current value of an investment is to be calculated by subtracting the cost from the value and dividing the result by the cost. To reiterate, the following example will be provided. To provide an example, if one were to purchase the property for $100,000, the initial payment would be $100,000. The market value of the house is now $150,000. It is evident that, in accordance with the principles of the ROI formula, a 50% return on investment can be deduced. The importance of ROI in this context is therefore self-evident. The process of comparison between assets of differing classes is facilitated, with the resultant data expressed as a percentage. Moreover, it furnishes a rudimentary metric with which to compare the profitability of an investment, constituting a fundamental element in all analyses and decisions made by companies and individuals alike. But it is limited. The following example will illustrate this point. In the first investment scenario, an initial investment of $1,000 is made in real estate, which is subsequently sold for a total of $1,200 after a period of 1 year. Therefore, the investor's return on investment, ROI, is 20%. In the second investment, the stock was purchased for $2,000 and subsequently sold for $2,800 after a period of 3 years. Utilizing the aforementioned formula, the calculated return on investment, ROI, is 40%. Accordingly, ROI demonstrates that the second investment is preferable. However, when the temporal factors are taken into consideration, it is evident that the time investment required to achieve a 40% return on investment, ROI, is 3 times that of the 20% ROI. It can thus be concluded that return on investment, ROI, is not the sole metric by which the value of an investment can be determined. The time value of money is the next concept to be examined. The process of continuous compounding is a key element in this context. It is to be posited herewith that one may posit an assumption regarding the existence of a savings account, which generates 10% interest per year over a 20-year period. The initial investment required for this account is $1. It is estimated that, over a 20-year period and assuming a 10% interest rate, the value of the account will increase to $6.73. This equates to 6.73 times the initial investment. This phenomenon, known as the power of continuous compounding or compound interest, underscores the significance of financial growth and its impact on economic development. The time value of money is a concept that is widely studied in economic theory. The concept under discussion posits that the value of money is greater in the present than in the future. This is due to 2 factors. Firstly, money has the capacity to accrue interest, as demonstrated in the example. Secondly, the purchasing power of money is increasing over time. Decreases have been observed as a result of macroeconomic factors, including inflation. The following question is posed for consideration. Should the $1 be received immediately or at a future point in time, say 5 years hence? As demonstrated in the preceding example, it can be deduced that the present value of $1 is desired. The rationale behind this can be found in the potential cash flows that money can engender during this period, as well as the ability to circumvent the potential ramifications of inflation. The net present value is the final of the 3 key concepts for this section of the video. The net present value concept is relatively uncomplicated. As the name suggests, the net of all cash inflows and cash outflows is used to determine the value of an asset. The term, cash inflows and outflows, is used in financial analysis to denote the revenue and sunk costs associated with a given investment. The following investigation will explore the calculation of net present value. Prior to the calculation of the net present value, it is imperative to comprehend the significance of this tool in the determination of the value of an investment. The net present value of an investment is said to be greater than 0 if it is deemed to have been a positive investment, with the consequence that it has generated favorable returns. In order to calculate the net present value, it is first necessary to understand the concept of the discount rate. The discount rate is the interest rate employed in discounted cash flow analysis to ascertain the present value of future cash flows. In essence, the interest rate applied by the Federal Reserve to short-term loans constitutes the primary indicator of financial policy. The present study employs the aforementioned methodology in order to calculate the value of money in the future. This is due to the fact that macroeconomic policies, such as inflation, have been shown to decrease the value of future cash flows. It is imperative to comprehend the definition of the discount rate in order to accurately calculate the net present value. In order to provide a basis for the subsequent discussion, it is first necessary to assume that a vending machine has been purchased. The financial outlay required for the acquisition of the vending machine was $10,000. This is reflected in year 0, with a minus $10,000 cash flow, which is a negative cost. In the initial year of operation, the vending machine generates a profit of $2,000. In subsequent years, the profit increases to $3,000, $5,000, and $7,000, respectively. Therefore, upon calculation, the net present value would amount to $7,000. However, when the discount rate is taken into consideration, which is predicated on the assumption of financial loss arising from rising interest rates, the net present value is reduced to a mere $4,704. Despite the fact that the amount received is less than the $7,000 that would have been received if the value of money had not decreased, it is still greater than zero. This indicates that the vending machine is indeed a profitable investment. The following Google Sheets presentation illustrates the financial obligations associated with purchasing a property. In order to provide a more concrete example, let us imagine that we are purchasing a house for $150,000. It is evident that the initial deposit of 20% of the total cost, equivalent to $30,000, has been made available to the purchaser. This results in a remaining balance of $120,000, which is to be settled through the utilization of a loan. To illustrate this point, consider a loan of $120,000 with an annual interest rate of 10%. It can thus be deduced that the annual payment for a 20-year mortgage would amount to $13,896. It is evident that, over the course of the following 20 years, the mortgage will be settled through the annual payments. Therefore, the initial payment is invariably the same amount as the previous year, whilst the principal amount decreases. Therefore, in the initial year, the initial capital is set at $120,000. Following the initial payment, the total sum remaining is $118,000. This sequence of events continues until the conclusion of the 20-year mortgage period, at which point the sum total is depleted. However, it is imperative to acknowledge the temporal variations in the principal amount. It is evident that from the initial year to the subsequent year, the principal in question underwent a marginal decrease. Notwithstanding the fact that a payment of almost $14,000 is pending, the total sum due is $2,000. The rationale behind this is that the majority of the payment is allocated towards the annual interest rate on the principal, which is 10% of $120,000, amounting to $12,000. Therefore, of the total sum of $13,896, $12,000 is allocated to cover interest charges, leaving a mere $1,896 to be applied to the repayment of the principal. This example serves to illustrate how interest rates can, in fact, result in significant financial losses. The total repayment amount for the loan of $120,000 is $277,904, inclusive of both the principal and the interest. This equates to an interest expense of $157,940. It is imperative to first establish a clear definition of the term capital and financial markets. The following discussion will attempt to shed light on the question of the nature of capital finance and the entities responsible for its provision. The following question is posed: By what means do businesses and governments obtain financial capital through these markets? The financial market can thus be defined as an economic entity wherein two or more parties convene with a view to the exchange of goods or services. Such locations may be physical, as in the case of a grocery store or supermarket, or virtual, such as the Netflix subscription page. Despite the fact that this is a less evident marketplace, it remains an area in which two parties, the individual person subscription and Netflix, come together to exchange goods and services. In this particular instance, the exchange is a Netflix subscription, which is a service. It is evident that financial markets are of significant importance. It is evident that financial markets play a pivotal role in facilitating the growth of firms and in achieving the objectives of individual consumers. A significant number of firms are engaged in the production of goods and services that are not available to the general public. Consequently, it is imperative for financial markets to be in existence, thereby enabling consumers to gain access to these goods. This is also of significance to firms. It is evident that, in the absence of the capacity to exchange the goods and services, there is an impediment to generating returns on their production, thereby impeding the possibility of growth. The subsequent discussion will address the stock and bond markets. The first issue to be addressed is the definition of the term stock. A stock is defined as a security that represents a portion of ownership in a company. Public companies are defined as commercial entities that engage in the sale of their shares on a public exchange platform, thereby rendering them accessible for purchase to the general public. Examples of such companies include Amazon, Apple, and Tesla. Should you wish to do so, it is possible to purchase their stock immediately. In contradistinction, private companies are held by a specific group of proprietors, who are generally the individuals who established the enterprise in the first place. In certain situations, the decision may be taken to sell stock privately, rather than on a public platform. Such transactions may be limited to family and friends. The following investigation will explore the question of what exactly constitutes a stock. The issuance of stocks by companies is a financial strategy employed for the purpose of raising capital to achieve specific objectives. These objectives may encompass such initiatives as business expansion, the accrual of capital for inventory, and related purposes. Stocks are also referred to as equity. As many of you will have observed in the Shark Tank program, the term equity is frequently employed. In this particular instance, Kevin has made an offer of $400,000 for a valuation of $8.2 million. Consequently, the company's total equity, otherwise referred to as stock, is valued at $8.2 million. It is evident that Kevin's financial contribution amounts to $400,000, constituting 4.8% of the total equity. Consequently, his ownership interest is equivalent to 4.85% of the company's total stock. So now what is a bond? A bond constitutes a financial instrument representing a loan that is provided by an investor, who is the individual or entity providing the capital, to a borrower, who is the individual or entity that is receiving the capital. It is evident that bonds can be issued by a variety of entities, in contrast to stocks, which are exclusively issued by firms. The issuance of bonds is a practice engaged in by firms, governments, states, and other organizations affiliated with government entities. Bonds can be categorized according to four primary features. The issue price is the price at which the asset is purchased. The face value constitutes the initial purchase price, as well as the accumulated interest payments. The coupon rate, otherwise referred to as the interest rate, is defined as the series of payments that an individual or entity will receive over the duration of the bond. The coupon date is the date on which these payments will be made. The maturity date is defined as the point in time at which the entire duration of the bond has been exhausted, and the initial issue price is repaid to the investor. It is evident that bonds are utilized for the funding of projects undertaken by these organizations. The duration of such instruments is contingent upon the maturity rate at the time of issuance. They are characterized by the presence of either fixed or variable payments. It is an intriguing observation that bonds exhibit an inverse relationship with prevailing interest rates within the financial market. The phenomenon can be explained by the fact that, as interest rates rise, the lower coupon rate of bonds becomes less desirable. Consequently, bond issuers are compelled to reduce their prices. A government-funded project may be defined as any initiative that is financed by the government and which has a purpose that aligns with the objectives of the government. Such projects may include the development of infrastructure, such as buildings, schools, paving roads, and other similar developments. In the event that the government is not already in possession of sufficient funds with which to undertake this project, it may be compelled to issue bonds in order to raise capital and pursue the project. This essay sets out to explore the differences between stocks and bonds. Consequently, equities are generally considered to carry a higher degree of risk. This phenomenon can be attributed to the inherently volatile nature of the stock market, which engenders fluctuations in company valuations, resulting in their appreciation or depreciation. Furthermore, it is important to note that stocks are only issued by firms or companies. Equity securities represent a form of ownership over a company, with the holder receiving financial returns in the form of dividends and capital appreciation. Dividends represent a distribution of financial resources from a company to its shareholders, constituting a proportion of the profits generated by the enterprise. Appreciation is defined as an increase in the total value of the company. Consequently, upon the acquisition of company stock, an investment that is initially valued at $100 and subsequently appreciates to $120, a financial gain of $20 is realized. Furthermore, the acquisition of stocks bestows the ownership of a company and, in certain circumstances, the capacity to exercise decision-making authority. The subsequent section will address bonds. Bonds are regarded as a lower-risk investment due to the fact that they involve fixed payments, which are established at the time of purchase. Subsequent to reaching maturity, the initial payment is returned to the investor. It is evident that bonds are issued by a variety of entities, including firms, governments, and other organizations. The concept of bonds is predicated on the notion of debt, rather than ownership. The purchase of a bond entails the obligation of the vendor to make payments to the purchaser. Additionally, bonds do not confer any decision-making authority, as they constitute merely a form of debt and not ownership. The risk inherent in this example is evident when considering the distinction between bonds and stocks. In this particular instance, the stocks are represented by the dark blue line, whilst the bonds are represented by the light purple line. The stock prices demonstrate high levels of volatility, oscillating in a cyclical manner. In contrast, bond prices exhibit a more stable and less volatile growth trajectory. This demonstrates that equities are significantly more volatile. Consequently, if an investor opts to divest a stock at a specific date, the potential for negative returns is heightened. Conversely, if the investor chooses to hold bonds, the option to sell is eliminated. However, once a bond reaches its maturity, it is highly likely that a profit will be realized, unless there is a default or bankruptcy of the company or organization from which the bond is purchased. The question therefore arises as to how the valuation of stocks on any given asset is determined. In order to ascertain the value of a stock, bond or other asset, it is necessary to consider two principal factors. The anticipated monetary inflows and outflows, in conjunction with the inherent risk associated with the valuation, are of paramount concern. As was outlined in the preceding discussion, cash flows represent the total revenues that will be generated, in addition to the sunk costs associated with the dissolution of an asset. And risk. The term, risk, is generally accepted to denote the probability of either financial loss or the eventuality of corporate insolvency, which would result in the loss of capital. The subsequent discussion will address the concept of stock valuation. The valuation of equities is an endeavor that is characterized by a considerable degree of uncertainty. This is partly attributable to the existence of a multitude of methodologies for determining securities' worth. For instance, the discounted cash flow method is employed, and this will be the focus of the ensuing discussion. The first of these is the constant growth divided by dividend discount method. The second is a technique known as comparables, which will also be discussed, including price to earnings, price to books and price to sales. Consequently, there is an absence of a standard convention for measuring a stock. When individuals are comparing stocks, it is recommended to utilize all available information and employ as many techniques as possible. However, this is impractical in real-world settings. The discounted cash flow method is employed in this instance. The discounted cash flow method is analogous to the preceding section, wherein the total anticipated cash flows for a given asset are considered, incorporating both sunk costs and the prospective revenues that are anticipated to be generated in the future. These values are then discounted, necessitating an adjustment to the valuation of money in accordance with macroeconomic characteristics such as inflation. This adjustment ensures that the future value of money is converted to its present value. A consideration of the advantages of this technique is therefore required. In principle, this approach constitutes the most robust method, provided that the analyst is confident in their assumptions and forecasts. Furthermore, it is not substantially impacted by transient market conditions or non-economic factors. In circumstances where the industry is experiencing a temporary deficit of resources, this technique guarantees that such factors are taken into account during the valuation process. This is a particularly useful technique when a company is being valued in an industry where there is an absence of competitors or only a small number of them. In such cases, the availability of comparable information is limited or non-existent. Consequently, forecasts are derived exclusively on the basis of individual company data. The limitations of this technique are evident in its capacity to fluctuate across a broad spectrum of values. This variability is attributable to the utilization of forecasts, which are inherently prone to inaccuracy. Moreover, it should be noted that this technique is significantly more time-consuming than the other evaluation techniques, which will be discussed in greater detail at a later point. Moreover, the forecasting of future performance is an arduous task, requiring the utilization of numerous statistical tools. Consequently, the resulting forecasts are likely to be both inaccurate and imprecise. The subsequent discussion will concern valuation frameworks and the use of comparable companies as a point of reference. So what are comps? The term, comps, is also used to denote comparables or multiples. This is a valuation technique that is based on the comparison of companies within an industry. The process entails the utilization of metrics, including price to earnings, price to book value, and analogous ratios that are pertinent to analogous companies within the same industry. The underlying principle behind the utilization of comps is predicated on the notion that enterprises operating within analogous industrial sectors tend to exhibit analogous financial and operational characteristics, a phenomenon attributable to the presence of shared market and economic factors. The process of evaluating the valuation of a company against its peers is a valuable tool for investors, as it enables them to gain insights into the company's performance within the industry. By assessing the valuation of the company in relation to its peers, investors can determine whether the company is over, under, or fairly valued. It is evident that the two most prevalent forms of compensation are the price-to-earnings ratio and the enterprise value to EBITDA, or EBITDA, ratio. The following examples illustrate the range of possible compositions. The following price-related ratios are available for consideration: price to earnings, price to sales, enterprise value to earnings before interest, tax, and appreciation, price to cash flow, and price to earnings. The superiority of these ratios to discounted cash flow with regard to temporal analysis is attributable to their expeditious calculation. In order to facilitate a swift and straightforward comparison between companies within the same industry, it is necessary to examine the financial documents of a company, calculate its figures, and compare them with the figures of other companies in the same industry. In this section, the focus will be on the subject of business strategy, with particular reference to the relevant financial documentation. The following discussion will firstly explore the concept of business strategy. It is a plan of action, or a policy, which has been designed in order to achieve the major or overall aim of a company. The present moment is pivotal in the development of a coherent economic strategy, as well as the formulation of plans that will ensure the future success of the company in achieving its objectives and attaining financial prosperity. It is evident that a fundamental component of the business strategy is the mission statement. The mission statement is defined as the concise articulation of the objectives and principles that guide the actions of a company. The fundamental components of a mission statement encompass the purpose of the enterprise, the target demographic, an exposition of the business's unique characteristics, and the values that inform its operations. It is evident that the aforementioned elements must be addressed within the confines of a limited number of sentences. The following examples will be examined. Microsoft's business strategy is to empower individuals and organizations worldwide to achieve more. The company has a global outlook and is dedicated to supplying products of the highest quality at a reasonable price in order to ensure customer satisfaction on a worldwide basis. Walmart's raison d'etre is to minimize expenditure so that its customers can enjoy a higher standard of living. A close analysis of these three statements reveals several common features. The rationale behind the selection of these three words is as follows. Firstly, their brevity is advantageous. Secondly, they are easily remembered. And thirdly, they serve to exemplify the core values and missions of these companies. The subsequent section will address the process of conducting a company analysis. A variety of tools are employed by companies when formulating their business statements. One of the principal tools employed is SWOT analysis. SWOT analysis is a tool that can assist a company in understanding its position within the marketplace and in assessing its competitive landscape. SWOT analysis is a tool that can be used to assess the strengths and weaknesses of an organization, as well as the opportunities and threats that it faces. The acronym SWOT is derived from the four elements of the analysis. The strengths of a company are defined by its competitive advantage, proprietary assets and high-performing products. It is evident that these are the company's strengths, given that they constitute unique features not possessed by competing companies. A company's weaknesses may be defined as the areas in which it is deficient in comparison to its competitors, the areas in which its competitors demonstrate superior performance, and any resource limitations that the company may be experiencing. It is evident that the company's strengths and weaknesses are intrinsic to its operations. Subsequently, the concept of opportunities and threats is introduced. Threats are defined as new legislation that has the potential to disrupt a company's operations, the emergence of new competitors in the market, and shifts in consumer attitudes and opinions. Opportunities are defined as technologies that a company can integrate into its processes in order to effect improvements. The term, emerging press and media, refers to those forms of communication that are currently in their infancy but which have the potential to assist a company in the generation of publicity. Finally, underserved markets are those sectors of the market that have not yet been adequately served by existing companies and as such represent a potential opportunity for new entrants. It is evident that threats and opportunities are not directly implicated in the company, and are instead external factors which have the potential to exert an influence over time. The following provides a more detailed exposition of the concept of strengths and weaknesses. According to the most recent academic consensus, strengths are defined as the internal attributes and resources of a company that propel it towards success. This concept signifies the domain in which the organization exhibits superior performance in comparison to its competitors and customers. A business's weaknesses are defined as the factors that impede the achievement of favorable outcomes. The identification of areas requiring improvement is facilitated by the process, thus illuminating the areas in which the company under scrutiny is found to be inferior to its competitors. Opportunities are defined as external factors that can be utilized to one's advantage. It is evident that these are prevailing market trends. In order to enhance revenue and provide a competitive edge, it is essential to capitalize upon these trends using one's strengths. Threats are defined as external factors that jeopardize the success of an organization. These advantages are held by competitors. In order to mitigate the aforementioned risks, it is imperative for employers to strategically leverage their strengths. SWOT analysis, when employed, can assist a company in comprehending its current position within its industry, as well as the potential future developments that may occur. Furthermore, it can facilitate the identification of strategies that would enable the company to progress in a manner that is conducive to its long-term success. The BCG matrix is a further instrument with which a commercial entity can assist itself in comprehending the significance of particular products or services that it retails. The BCG matrix, also referred to as the Boston Consulting Group matrix, is a business analysis tool that assists organizations in evaluating the performance and potential of their product portfolio. As illustrated in the diagram, there are 4 distinct categories: stars, cash cows, question marks, and dogs. The categorization of products can be based on their market growth rate and relative market share. Stars represent products with high market shares in rapidly expanding markets. The potential for generating significant profits is evident, given their strategic position within this industry. It can thus be deduced that in the event of a company attaining a dominant market share of 90% within a niche market that is experiencing rapid growth, there is a high probability that the product in question will become a market success. Cash cows are products that enjoy high market shares in markets that are not expanding at a rapid rate. Whilst these enterprises may not demonstrate comparable levels of growth potential, they nevertheless generate a consistent revenue stream, a factor which is frequently considered advantageous by business owners. It has been demonstrated that, whilst there are certain similarities with stars, the latter do not possess the same future potential. Instead, they are generating revenue in the present. Question marks are indicative of products which companies may have a limited market share in at present. However, it is reasonable to hypothesize that the market will expand in the future. A company must consider whether to invest in a particular project with a view to developing its market share, and indeed potentially creating a star product. Alternatively, it may be more prudent to abandon the project in order to avoid the risk of failure. Furthermore, canines are a product with a limited market share and negligible market growth within a market that is not expanding. The profitability of the company will not be significantly impacted by the presence of canines. In the event that a company is required to reduce the services it offers, canines will invariably be the first to be affected. The BCG matrix is a tool that can assist a company in the effective allocation of its resources. It does this by suggesting strategies for products or services that fall into each specific quadrant. The final strategic business tool to be discussed is Porter's generic strategies. Porter's generic strategies represent a set of strategic approaches developed by Michael Porter. The purpose of these strategies is twofold. Firstly, to assist businesses in understanding their position within the industry, and secondly, to enable them to gain a competitive advantage. It is evident that the diagram under consideration comprises 4 quadrants. It is evident that there are 3 key factors to consider: cost leadership, differentiation, and cost focus. Cost leadership is a strategy that focuses on an organization's efforts to become the producer of goods or services with the lowest production costs within a given industry. This is achieved by economies of scale, efficient operations, and cost controls. This has the potential to appeal to a broad consumer demographic, which may act as a deterrent to new entrants in the industry. Subsequently, we encounter the concept of differentiation. The objective of differentiation is to create a unique or distinctive product that is not found in other products on the market. This objective can be accomplished through a variety of means, including but not limited to unique product design, branding, and customer service. The provision of a valuable and unique product or service often enables companies to apply a premium price. It is reasonable to hypothesize that prices and customers will be willing to pay. As the focus shifts towards the bottom, the focus shifts to the niche strategies employed within the niche market. It is evident that the implementation of such strategies frequently entails the concentration of efforts on a specific market or a specific segment. It is possible to achieve this objective through either a cost focus or a differentiation focus. The former involves becoming the lowest cost leader in a particular market segment and offering a product that is tailored to the specific needs of that market. The latter involves offering a product that is tailored to the specific needs of a particular market segment. The strategic focus of companies on smaller, specialized markets has been demonstrated to engender more robust relationships with customers, whilst concomitantly facilitating more straightforward maintenance of such relationships. The adoption of one of these generic strategies by businesses would allow them to align their operations, marketing efforts and resource allocations to create a sustainable competitive advantage. The following discussion will focus on the three primary financial statements that are required for all companies to disclose. The three financial statements are as follows: the profit and loss account, the statement of financial position, and the cash flow forecast. It is important to note that these documents are referred to by a variety of names. As indicated in the text, some of the more common alternative forms are listed in parentheses. Should you encounter an income statement or a profit and loss statement online, it is important to note that these are synonymous. It is evident that each of these statements is intended for a distinct purpose, a topic that will be examined in greater detail in the forthcoming discussion. When considered collectively, these elements offer a comprehensive perspective on a company's financial health and operational efficiency, as well as an assessment of its stock value. It is also important to note that all publicly traded companies are obligated to disclose the three aforementioned documents to ensure transparency with the public and their investors. In contrast, private companies are not subject to this requirement. It is also important to note that in these documents, negative numbers and losses will be represented with parentheses. In earlier examples, the color red was employed. However, it is imperative to acknowledge the significance of parentheses in financial documentation, as they serve to distinguish negative numbers and ensure the integrity of data interpretation. Very well. The initial step in this process is to ascertain the statement of profit or loss. The profit and loss statement is a financial statement that provides a comprehensive overview of a company's revenues, costs, and expenses over a specified period. It is evident that all of these financial documents are characterized by an initial section. It is evident that the document will comprise the title, the company, and the nature of the financial document. Moreover, of particular significance is the time period from which the data originates. In this particular example, the end of the year is arbitrarily set at any given point in time. It is acknowledged that the statement of profit or loss is also referred to as the statement of operations, statement of financial results, income statement, earnings statement, expense statement, and income statement, amongst others. In order to gain a comprehensive understanding of the financial health of a company, it is imperative to undertake a longitudinal analysis of the profit and loss statement. This approach enables the identification of trends and fluctuations over time, providing a valuable insight into the financial health of the company. In this particular instance, the time frame is limited to a single year. However, investors generally examine multiple years and utilize a horizontal analysis, a topic that will be addressed subsequently, to assess a company's growth over an extended period. Consequently, when examining this document, it is imperative to initiate the review from the beginning. The initial focus is on sales revenue, which is then subjected to a reduction over time in order to ascertain the retained profit. According to the principles of accounting, the term, cost of sales, is defined as the total expenses incurred in the production and distribution of goods. These expenses encompass the costs associated with the manufacturing of goods, as well as the various costs incurred during the process of selling goods to customers. This encompasses the illumination within the store premises. This process ultimately results in the determination of gross profit. Subsequent to the deduction of expenses, the investor is entitled to receive their profits prior to the payment of interest in tax. Following the payment of interest, profits are realized prior to the imposition of taxation. Following the settlement of tax obligations, a profit is realized for the given period. It can thus be concluded that the aforementioned quantity represents the residual surplus remaining after all other company expenses have been deducted. Subsequently, Dividends are distributed to shareholders, thereby accumulating retained profits within the corporate entity. It is imperative to acknowledge that this enterprise is driven by the pursuit of profit. It is noteworthy that even non-profit entities are subject to the same reporting requirements. Nevertheless, in lieu of profit, the term surplus is employed, given that the objective is not, in fact, profit. The following statement provides a comprehensive overview of the organization's financial position at a given point in time. This statement is somewhat extensive in nature, therefore, it will be examined in two sections: assets and liabilities. This statement can be interpreted as positing the question of how companies should approach the conclusion of a financial period. In the initial phase, the assets are to be considered. Once more, the sequence of information is as follows: company name, document title, and the period for which the document is reporting. In this section, an examination is conducted of the assets, which are categorized as either non-current or current. Non-current assets are defined as those assets that a company will retain for a period exceeding 1 year. This encompasses the manufacturing facility in which the product is assembled, in addition to any technical apparatus utilized during the production process. In contrast, current assets are those that a company will retain for a period of less than a year. This includes assets such as cash, accounts receivable, and inventory. Therefore, upon calculation of the total value of non-current assets, the result is 800, whereas for current assets, the figure is 1,100. Therefore, the total assets of the company are equivalent to 1,900. One matter that may be observed is that of accumulated depreciation, which is indicated within parentheses and is a negative factor. Whilst it is beyond the scope of this course to provide a comprehensive overview of the subject, I will endeavor to offer a concise and accessible introduction to the concept of depreciation. This accounting technique is employed by companies with a view to decreasing their overall assets. This can result in benefits for the companies in terms of tax breaks and other such advantages. Indeed, upon the inclusion of non-current assets and current assets, the total assets are found to be 1,900. In the context of financial management and accounting, it is imperative to distinguish between two distinct categories of liabilities: current and non-current. Current liabilities are defined as obligations that a company will hold for a period of less than a year. Non-current liabilities are defined as those held by a company for a period exceeding 1 year. A bank overdraft constitutes the utilization of a bank account to the point of reaching a negative balance. It is considered a current liability. Trade predation is defined as the practice of engaging in commercial transactions with another entity, wherein the counterpart grants the option to defer payment, thereby effectively establishing an implicit obligation to pay, IOU. In addition, the institution offers short-term loans, which are repaid within a period of less than a year. It is evident that the aforementioned elements collectively constitute the total current liabilities. Other non-current liabilities are comprised of long-term loans, which are typically obtained from financial institutions. It is evident that these elements collectively constitute the total liabilities. Net assets are defined as total assets minus total liabilities. Therefore, the total assets of the entity in question amount to £1,900, whilst the total liabilities are £800. Therefore, the calculation of net assets is as follows: 1,900 minus 800, which equals 1,100. A crucial calculation to ascertain the accuracy of the financial position is to determine the value of assets and equate them to liabilities plus shareholder equity. If the result is equal, then the process has been executed correctly. Shareholder equity can be defined as the share capital of a company, the value of its shares, and the retained earnings of the company for the period under consideration. The aforementioned document is intended to provide a comprehensive overview of the subject's current financial situation. The cash flow forecast is now available for consideration. The cash flow forecast is for a shorter period of time, and it provides a detailed analysis of all the financial inflows and outflows of a company over a 3-month period. The aforementioned system enables advisors to evaluate the individual inflows and outflows of a company, thereby ascertaining the importance and cost of specific company elements. This assessment facilitates the identification of opportunities for reduction, with the objective of enhancing the total net cash flow of the company. Moreover, it enables the company to undertake a monthly comparison, thereby facilitating the observation of the effects of its operations over time. As demonstrated in Figure 1, the initial balance in January is recorded as 800. Nevertheless, the aggregate cash outflows, amounting to 306, exceed the inflows, which total 300. Consequently, the closing balance is reduced by 6 million. Therefore, the closing balance is 2 million. It is evident that the company is experiencing negative cash flow over a period of 3 months. This indicates that operating in this manner is having a detrimental effect on the company, suggesting that certain outflows must be reduced or inflows increased. In the absence of such measures, companies may be compelled to explore alternative financial instruments. As previously stated, it is imperative that these 3 forms, which are of paramount importance, be made public for publicly traded companies. It is imperative that companies ensure transparency with their investors and the general public. This is the only way to ensure that investors can make informed decisions regarding whether to invest in the company. It is imperative that these documents are made available to all relevant personnel within the company, as they contain essential data for the execution of crucial financial calculations, including the return on equity, ROE. It is only possible to achieve this by comparing across the documents or by cross-referencing them. Indeed, it is possible to locate specific financial documentation of a publicly traded company on the Internet at the present time. However, it should be noted that this is not a possibility when working with private companies. The subsequent stage of the process will be to analyze the financial statements that have been recently reviewed. It is evident that there are 3 distinct techniques that can be employed in this context. Ratios, horizontal analysis and common size techniques can be utilized in this context. The initial step in the analysis will be the examination of ratios. It is this author's opinion that ratios represent the most elementary and expeditious method of analysis. There are 4 distinct categories of ratios. Firstly, profitability ratios are utilized to gauge the return on investment. Secondly, liquidity ratios are employed to measure the ease with which financial assets can be transferred. Thirdly, activity ratios are employed to represent day-to-day operations. Finally, leverage ratios are used to measure the effectiveness of debt utilization. The utilization of profitability ratios is a key component of this analysis. Profitability ratios are financial indicators utilized for the evaluation of a company's capacity to generate profits in relation to its revenue, assets, and equity. As illustrated on the screen, the key profitability ratios include the gross profit margin, which measures profit after the deduction of production costs or the cost of goods sold, and the net profit. The margin is a financial term used to assess overall profit after all expenses have been deducted. Furthermore, the return on assets and return on equity ratios are employed to demonstrate the efficiency with which a company generates profits from its assets and shareholder equity, respectively. The utilization of these ratios by investors and stakeholders is instrumental in the assessment of the company's profitability and its efficacy in the generation of earnings from revenue. As is apparent, the formulas for each of these profitability ratios are presented on the screen. This information can be found in 3 financial documents. The subsequent topic to be addressed is that of liquidity ratios. Liquidity ratios are financial metrics used to evaluate a company's capacity to honor its short-term financial obligations. The primary objective of the measurement is to ascertain the firm's capacity to expeditiously convert assets into liquid assets, thereby facilitating the recovery or settlement of immediate liabilities. It is evident that common liquidity ratios include the current ratio, which divides the current assets by the current liabilities, and the quick ratio, which excludes less liquid assets such as inventory. It is evident that these ratios offer insights into a company's financial health and its capacity to manage unexpected expenses or periods of economic decline. It is generally accepted that high liquidity ratios are indicative of superior short-term financial stability and flexibility. Nevertheless, it should be noted that they do not represent the definitive analysis technique for liquidity. Activity ratios are also referred to as asset utilization ratios. These ratios provide an analysis of the efficiency with which a company manages to use its assets to generate revenue. The provision of insights is indicative of the extent to which a company deploys its resources and operational capabilities. For instance, the term inventory turnover is employed to denote the frequency at which inventory is sold and replenished. Furthermore, the average collection period is a metric that is often utilized in such contexts. Activity ratios have been shown to assist businesses in optimizing their operations, managing working capital, and identifying areas where improvements can lead to increased productivity and profitability. Finally, the issue of debt leverage ratios is addressed. The term debt ratio is a financial metric used to evaluate a company's level of indebtedness relative to its equity or assets. These ratios offer insights into a company's financial leverage and risk. The following debt ratios are of particular relevance. The debt-to-asset ratio, which serves to indicate the proportion of debt in relation to the total assets of a company. This ratio has been shown to assist in the evaluation of a company's capacity to manage its debt obligations. Furthermore, it offers valuable insights to investors and creditors, providing information on the firm's financial stability and its transfer risk. It is important to note that these ratios are not straightforward and do, in fact, have subtle nuances. Despite the simplicity and ease with which these ratios can be calculated, they're not particularly useful when comparing firms across industries. To illustrate this point, consider the following examples: Walmart and Honda. In the context of liquidity ratios, the quick ratio is a particularly salient example. When employed to compare the financial health of entities such as Honda and Walmart, it is imperative to recognize the inherent differences in their respective business models and operational structures. It is probable that the inventory management and equipment processing methodologies employed by the two companies will exhibit significant disparities. Nevertheless, the utilization of such ratios is advantageous when conducting a comparative analysis of companies operating within the same industry and in analogous positions. It is now possible to proceed with a simplified version of a consolidated income statement and the relevant financial documentation, with the aim of calculating two ratios, gross profit margin and net profit margin for Tesla. The data presented here was obtained from the Wall Street Journal. It is a consolidated income statement of Tesla, which includes all the relevant information. The following formula is employed to calculate gross profit margin. The calculation should thus be made by subtracting the cost of goods sold from the total revenues, and then dividing the result by the sum total of the revenues. It is possible to use Excel to perform a subtraction between the revenues, which are located in the specified cell, and the cost of goods sold, which is located in the adjacent cell. This is achieved by utilizing the minus function. This calculation results in a total of 20,853. It is now possible to utilize the divide function in order to calculate the quotient of the specified value divided by the total revenues. The precise formula for this process is as follows. This calculation provides the gross profit margin ratio of 0.255, and so on. It is now possible to undertake a similar analysis with regard to the net profit margin. However, this is a much more straightforward process. This is merely the net income divided by revenues. The next step is to utilize the divide function in order to ascertain the net income, which is located here. Subsequently, the aforementioned quantity is to be divided by the revenues, which are indicated in the text. The calculation of this value is possible through the utilization of the Excel program, which yields a result of 0.15446. This is a highly simplified example. The information presented in this Excel spreadsheet is elementary in nature. In essence, When calculating other ratios, it is imperative to cross-reference the relevant financial documents, as a significant proportion of the data can be found in the cash flow forecast, while other elements are disclosed in the income statement and so forth. Consequently, the situation becomes considerably more complex. However, if all the relevant files are available, as would be expected for a publicly traded company, then the necessary calculations can be performed with ease. The subsequent technique is known as horizontal analysis, otherwise referred to as trend analysis. Horizontal analysis of financial statements is defined as the process of comparing financial ratios and benchmarks with items over a number of accounting periods. This method is also referred to as trend analysis. Horizontal analysis is a method of financial statement analysis that enables the assessment of relative changes in different aspects of the financial statements over time. The following example will illustrate this point. One observation that merits attention when perusing these statements over an extended period is the manner in which the most recent years are situated in the leftmost column, while the earliest and most senior years are positioned in the rightmost column. This configuration stands in contrast to the conventional left-to-right reading style that is customary in English. It is imperative to bear this in mind. However, an examination of the relevant data reveals an increase in sales, cost of sales and profit. This calculation is possible. It is possible to calculate and list the numerical change in this column. The percentage change can be enumerated here. The percentage change is calculated by taking the difference between the two values and dividing this by the overall amount. This phenomenon is also referred to as the year-over-year change. As previously demonstrated in the consolidated income statement for Tesla, the same alterations can be observed over time. It is evident that the leftmost column corresponds to the most recent year, which is 2022, while the rightmost column represents 2018. The following data set was collected over a period of 5 years and is representative of the information recorded for Tesla. It is important to bear in mind that a proportion of the data was collected during the course of the pandemic of the novel pathogen severe acute respiratory syndrome, SARS-CoV-2, which may have had an effect on the results. It is imperative to acknowledge that macroeconomic factors, such as pandemics or other industrial shocks, have the capacity to influence the integrity of the data. However, the contribution is not of significant magnitude, particularly in the context of Tesla. It is evident, upon thorough examination, that there has been a considerable increase in sales revenue. The data indicates a consistent upward trend, with an initial increase from 21,000 to 24,000, followed by a more pronounced rise from 2020 to 2022, reaching 20,000 and then 30,000. It is evident that analogous processes can be observed across a range of other factors and items. It is evident that this horizontal statement can be utilized as a means of analyzing growth over time, even in the context of Tesla. The final instrument to be examined in this section is common size analysis, which is a financial statement. The final technique to be examined in this section is common size analysis. Common size financial statements present each line item as a percentage of a base figure indicated within the statement. This facilitates vertical analysis. Common size financial statements are a tool that can be used to analyze and compare a company's performance over several periods. The common size percentages can subsequently be utilized to facilitate a comparison with the percentages of competitors and to determine how a company is performing in relation to the rest of the industry. A common size income statement is an accounting document which presents each line item as a percentage of the value of revenue or sales. A common size balance sheet is a financial statement that presents a numerical value and a percentage representation of total assets. In the following example, the focus will be on a common size statement for an income statement or balance sheet. The following example is provided for illustrative purposes only. As is apparent, the conventional elements of a balance sheet or statement of financial position are present, with the additional inclusion of a column that expresses all elements as percentages. In this particular instance, it could be argued that percentages are of limited use, and this assertion would be vindicated by the evidence. The rationale behind this phenomenon is that the figures presented herein are unambiguous. The total assets are 100,000, which corresponds to 100% of the total assets. It is evident that these figures are highly uncomplicated. However, in circumstances where numerical data are considerably more varied and complex, these percentages facilitate the interpretation and monitoring of a greater volume of information. In this particular instance, the aforementioned process proves to be of significant assistance, insofar as it is capable of demonstrating the proportionate allocation of assets, including current assets, into various forms. In this particular instance, the majority of the organization's current assets are constituted by total cash and inventory, with the remainder comprising prepaid expenses and accounts receivable. It has been posited that the company may require investment in alternative revenue-generating assets, and that it may be experiencing issues with its inventory, with a consequent need to convert inventory into revenue. An examination of non-current assets reveals that the majority of assets are allocated to property and equipment, with a comparatively negligible allocation to goodwill. This process will facilitate the identification of the value contributed by specific components of the business, as well as those that offer less substantial contributions. In the non-current example, it is evident that the company possesses significant value in its equipment, property and plant, while the brand name and value, i.e., goodwill, are not as substantial. This can also assist in the identification of the components of liabilities that are most significant and those that are least significant, and the determination of subsequent measures to address these and to prevent the emergence of any further issues. As previously mentioned, a similar phenomenon is observable in other forms of statements, such as the income statement. However, it should be noted that, in essence, these statements represent merely a different financial statement. Very well. In the event that the opportunity arises to install solar panels on one's residence, it is advisable to consider the implications of such a decision. The solar panel company has stated that the cost of installing solar panels will amount to $10,000. However, it is asserted that, in the long term, financial savings can be achieved. The decision of whether to proceed with the investment is, therefore, a complex one. In this class, the focus will be on the subject of capital budgeting. The following discussion will attempt to provide a definition of capital budgeting. Why do we do it? And how is it done? The utilization of these tools will facilitate the determination of whether the investment in solar panels is warranted. The following discussion will therefore firstly consider the definition of capital budgeting. Capital budgeting can be defined as the process of evaluating and selecting long-term investment projects, such as the installation of solar panels, which require substantial financial investment. The decision-making process is a critical aspect for both businesses and individuals, as it involves the evaluation of projects with a view to ascertaining their viability for future returns or benefits. Capital budgeting is a process that assists organizations and individuals in the effective allocation of their financial resources. The primary objective of capital budgeting is to maximize the value of investments while minimizing the risk of making poor investment decisions. The approach is systematic in nature. It takes into consideration not only the immediate costs and returns, but also the long-term impact on financial performance and overall strategic goals of an individual or business. The primary question to be addressed is the rationale behind companies' investment in fixed assets. Investments have been shown to have a number of beneficial effects on companies. Firstly, they have the capacity to increase productivity. Secondly, they can assist companies in circumventing regulations. Furthermore, investments can be innovative, thus providing companies with a unique advantage. A plethora of further reasons can be advanced for this phenomenon. The importance of capital budgeting in valuation is a subject that merits closer examination. Capital budgeting is of significance for a number of reasons, of which the following three are the most salient. Firstly, it facilitates effective resource allocation. In the context of constrained financial resources, capital budgeting emerges as a pivotal strategy, enabling organizations to prioritize investments that demonstrate the greatest potential for return. The aforementioned issue is also conducive to long-term planning. The rationale behind this is that it enables companies to formulate strategic plans for the future by incorporating the ramifications of their investments into the decision-making processes. This is facilitated by the utilization of various analytical tools that will be expounded upon in subsequent sections. These tools enable companies to assess the potential outcomes of their investments over an extended time frame, thereby facilitating the mitigation of risk while optimizing returns. Furthermore, the text delves into the concept of the time value of money, a topic that will be explored in greater depth in forthcoming sections. Nonetheless, capital budgeting is predicated on the recognition that the time value of money is a valid economic consideration, i.e., that the present value of a dollar is greater than its future value. This approach also ensures that cash flow predictions are appropriately discounted. The following investigation will explore the manner in which corporate entities finance their investments. The financial burden is discharged in three distinct ways: through cash flow, debt, and equity. It is imperative to first comprehend two fundamental concepts prior to embarking on a discussion concerning capital budgeting and the methodologies involved in its consideration. The term, internal rate of return, or IRR, is employed to denote the financial profitability of an investment, as well as the cost of capital. The internal rate of return, IRR, is a financial term employed to evaluate the potential profitability of an investment or project. The internal rate of return, IRR, is defined as the anticipated annual growth rate of an investment. Should the internal rate of return, IRR, exceed the potential earnings from a low-risk investment, such as a bank deposit or a portfolio of low-risk stocks, then the project may be considered worthwhile despite its potential risks. In summary, the IRR is a metric that assists in determining the viability of a business concept as a worthwhile investment. The following is a detailed description of the steps involved in capital budgeting. Initially, a project proposal is formulated. The process entails the consideration of investment opportunities by individuals or businesses, followed by a judgment of its viability. Subsequently, management undertakes a review and prioritization of projects, with the basis of this decision being their economic viability. Following a thorough examination of the potential cash flow projections, the decision regarding the advisability of an investment for the company will be determined by management, with the investment then being given either priority or being disregarded. Subsequently, financial resources are assigned to these initiatives to facilitate the development and to monitor the attainment of objectives in order to ascertain the veracity of the projections. In the event of inaccurate projections, funds are subject to one of three possible adjustments: removal, reduction, or increase. Following the completion of the investment, companies are able to engage in a period of reflection on the process, during which they can determine whether it would be advisable to initiate similar investments in the future. The following discourse pertains to capital cash flows. The value of an initial investment is determined by the cost of the new asset, along with the installation expenses associated with the new asset, minus the after-tax proceeds from the sale of the old asset. It is imperative to bear in mind that the after-tax proceeds from the sale of a capital asset are equivalent to the sale price minus the tax on capital gains. This concept, however, is somewhat beyond the scope of this course. However, it is imperative to comprehend that this is a factor that is taken into consideration during the process of determining the initial investment price. Consequently, capital budgeting engenders alterations in working capital. Should a current asset experience an increase in value, this would be indicative of a use of working capital. Should the current liabilities of an entity increase, this can be considered a source of working capital. It is evident that current assets are comprised of liquid assets, such as cash and inventory, which are considered as uses of capital. Conversely, current liabilities encompass financial obligations, including loans, which are recognized as sources of working capital. An augmentation in net working capital signifies that the company is in receipt of a monetary influx. Conversely, a diminution in net working capital signifies that the company is expanding financial resources. The three primary methodologies employed in capital budgeting to determine the investment decision are the payback period, the net present value, and the internal rate of return, IRR. These will be discussed in turn. The payback period is a fundamental concept in financial analysis that quantifies the time required for a company to recoup its investment in a fixed asset. In this particular instance, the focus is on a Ford factory. The initial financial outlay required for the investment in this Ford factory is $5,000. However, as time progresses, the property has been found to generate positive cash flows. The payback period is a financial metric used to determine the time required for a company to generate a net positive cash flow. The payback period is a financial metric used to determine the time required for a company to generate a net positive cash flow. As is evident in the data, the initial cash flows are negative, with a cumulative cash flow that remains in the red until year 4. It is at this point that the cash flows finally become positive. We shall now return to the example previously cited. The cost of the solar panel is $10,000. The decision makers must consider whether the investment should be made. It is evident that the implementation of capital budgeting techniques facilitates the prediction of cash flows. The cash flows over the years are thus $2,000, $2,500, $3,500, $4,000, and $4,500, with an initial cost of $10,000. The installation of these panels is a decision that must be made. It is evident from the calculation of the cost of capital, which is 12%, that any alternative investment opportunity would generate a net present value of $1,200. Should the investment in solar panels exceed the cost of capital, then it can be considered a favorable investment. The application of discounting to our cash flows enables the determination of a value. It has been determined that the value of the solar panels is $1,219, which is greater than the value of our cost of capital. This is due to the fact that the net present value of the solar panels is greater than our cost of capital. The following section will demonstrate the calculation of net present value and how this is affected by the discount rate and cash flows. The configuration of the Excel function is such that the discount rate is designated as %, which is equivalent to our cost of capital, and our cash flows are duly accounted for. This can be achieved by typing equals NPV, selecting the discount, comma, and selecting our cash flows, which yields the same number in both instances. Should adjustments be made to the factors in order to ascertain the impact of varying scenarios, the numerical values can be altered to facilitate this investigation. It is evident that if the discount rate had been set at 20% as opposed to 12%, the net present value would have been subject to a reduction. This suggests that alternative investments with a higher cost of capital could have yielded a superior return than investing in solar panels. Nevertheless, a reduction in the cost of capital to approximately 5% results in a significant increase in the net present value. This demonstrates the impact of varying costs of capital on the net present value of investments by means of a comparative analysis of alternative investments. Furthermore, an investigation into the manner in which cash flow affects the net present value can be conducted. It is evident that if the initial cash flow is increased from $10,000 to $20,000, the cost is effectively doubled. Consequently, the net present value experiences a substantial decline. This demonstrates the impact of price on investment value. It is evident that an augmentation in cash flows has a considerable impact on the enhancement of net present value. In this section, the discourse will center on macroeconomics. The purpose of this discourse is to initiate a comprehensive examination of the foundational principles of macroeconomics. Macroeconomics is a branch of economics that focuses on the overall behavior of an economy. It does so by examining large-scale economic factors, including economic growth, inflation, unemployment, and national income. The present study examines the manner in which policies and events impact the economy in its totality, as opposed to the impact on individuals, such as individual businesses or individual markets. The following factors must be considered when analyzing macroeconomics. the size of the economy, economic growth, government policy, fiscal policy, monetary policy, inflation, and international trade. The majority of these issues will be addressed in due course. It is imperative to comprehend the business cycle. The business cycle is inextricably linked to the field of economics. Everything is cyclical. The business cycle, also referred to as the economic cycle, is defined as the recurring pattern of fluctuations and the overall activity of an economy over time. The process can be categorized into 4 distinct phases, as illustrated in the accompanying diagram. In this example, the process commences at the trough, which is defined as the lowest point. The trough, therefore, is the lowest point in the business cycle. At this juncture, economic activity has reached its nadir and economic conditions are at their most dire. Nevertheless, at this juncture, the economy is conducive to a prospective turnaround as it progresses towards the expansion stage. The following features of this stage are worthy of note. Firstly, the monetary and fiscal policy employed by the central banks and governments. Secondly, an increase in economic growth. Thirdly, an increase in employment and manufacturing from this trough. And fourthly, a gradual shift towards increases in profits. The subsequent phase is the expansion phase. It is evident that during this phase, economic activity, including but not limited to production, employment, and consumer spending, is on the rise, as set by the trough. It is evident that businesses are undergoing expansion, which is accompanied by a pervasive sense of optimism and an increase in consumer confidence throughout the economy. The phenomenon of growth is driven by a number of factors, including an increase in consumer demand, investment, and also by monetary and fiscal policy. It is evident that the repercussions of fiscal and monetary policy are beginning to yield favorable outcomes. Concurrently, governments and central banks are progressively reducing their interventionist measures. Notwithstanding the fact that economic growth remains favorable, it is important to note that it is not as rapid as it was during the trough. At this juncture, corporate entities continue to engage in the recruitment of personnel, while manufacturing activity persists. Consequently, corporate profit margins begin to rise. The ascent to the summit is then undertaken. The peak represents the highest point of economic activity in the business cycle. At this juncture, the economic growth rate exhibits a decline, reaching a state of maximum output. However, indications of nascent inflationary pressures may begin to emerge. At this juncture, fiscal and monetary policies implemented by central banks and governments may diverge in a manner that is antithetical to the promotion of excessive growth, which is characterized by inflation. Moreover, economic growth has reached a state of stagnation, and employers are encountering difficulties in sourcing suitable candidates for employment. Concurrently, wages are experiencing an increase in their purchasing power. This phenomenon can be attributed to the impact of inflation. Furthermore, it is observed that earnings begin to fall short of workers' expectations in the context of favorable economic conditions. This phenomenon is known as a recession or a contraction. Consequently, following the peak, the economy enters a phase of contraction. As previously mentioned, economic indicators such as GDP, employment, and consumer spending are beginning to demonstrate a downward trend. In the event of a decline in production, businesses may be compelled to initiate a reduction in the workforce. This, in turn, has the potential to engender a diminution in consumer confidence. This phase is commonly referred to as a recession. However, the definition of this term varies depending on the severity and duration of the period in question. The business cycle is driven by a number of factors, including shifts in consumer and investor sentiments, advancements in technology, and modifications to monetary and fiscal policies. Nevertheless, it is a continuous phenomenon that occurs with consistent regularity. However, it should be noted that the graph indicates the business cycle to be at its lowest point once more. It is important to note, however, that the economy is undergoing consistent growth, thus indicating an upward trend. However, these cycles are observed to extend throughout the upward trend, as evidenced by the available data. A thorough examination of the data reveals that the trough in the original early cycle is marginally lower than the trough that occurred after the recession. This indicates that the economy is expanding. However, it is also undergoing cyclical fluctuations. The following key factors of the macroeconomy will be discussed. The key economic indicators under discussion are gross domestic product, GDP, unemployment, inflation, and interest rates. The following discussion will firstly address the question of the definition of GDP. Gross domestic product, GDP, is a measure of the total value of goods and services produced within a nation over a specified period, typically 1 year. It is calculated by adding together the total cost of goods being sold within the country during that period. The calculation of gross domestic product, GDP, is derived from the following equation: GDP equals C plus I plus GA euro, XA euro, M, where C denotes consumer spending, I represents investments, G stands for government spending, and X minus M signifies the difference between exports and imports. It is imperative to acknowledge the interplay between industries and business cycles when analyzing economic data. It is evident that specific industries and companies are categorized into classifications designated as cyclical or defensive categories. Cyclical industries are those which are subject to the repercussions of the business cycle. At certain points in time, there will be periods of significant growth. However, there will also be periods when operations will be non-existent. This phenomenon may be exemplified by the hotel industry, resorts, dining, and any other industries that are characterized by the production of luxury goods or services, the provision of which is driven by the demands of consumers with more affluent purchasing power. In contrast, the business cycle exerts a relatively minor influence on the operations of defensive industries. This necessity arises from their indispensable role in facilitating human operations. Examples of such services include health services, utilities, and health technology. However, it is important to note that certain industries are positioned in a manner that is neither entirely cyclical nor defensive. For instance, the consumer services sector is cyclical to a certain extent, and also somewhat defensive in nature. For instance, the provision of accommodation is of a cyclical nature and to a certain extent defensive. It has been observed that in specific localities, certain residential properties, which might be regarded as luxurious, exhibit cyclical fluctuations in their rental or Airbnb occupancy rates. Nevertheless, fundamental accommodation is a defensive mechanism, since humans require it at all times. The initial issue to be addressed is that of unemployment. Unemployment can thus be categorized into 3 distinct classifications: cyclical, structural, and frictional. The concept of cyclical unemployment is therefore of particular interest. Cyclical unemployment is the consequence of fluctuations in the overall economy. In the event of an economic recession or downturn, demand for goods and services is known to decrease, with the result that businesses are compelled to scale back production. Consequently, this has resulted in the termination of employment for workers, which has, in turn, led to the occurrence of cyclical unemployment. The construction industry is a pertinent case study. In periods of economic prosperity, there is an increased demand for new residential properties and infrastructural projects. In response to this growing demand, construction companies have been compelled to recruit additional personnel. However, in the event of an economic downturn, there is often a decline in the demand for new projects, which, in turn, results in companies in the construction sector reducing their workforce. This has the effect of leading to cyclical unemployment for construction workers. In a similar manner, within the tourism sector, periods of economic prosperity are often accompanied by an increase in the disposable income of individuals, which, in turn, leads to an increase in travel and exploration. This phenomenon results in an augmented demand for a variety of services and amenities, including flights, hotels, and entertainment activities such as cinematic screenings. In the context of an economic downturn, individuals are compelled to reduce expenditure, resulting in a decline in travel and, consequently, diminished demand for tourism-related services. Consequently, there has been a decline in employment opportunities within this sector. In both cases, cyclical unemployment is closely associated with the fluctuations in the business cycle, as previously observed. In the context of economic fluctuations, industries with a high degree of reliance on consumer spending and investments may encounter fluctuations in employment levels due to the cyclical nature of demand. The subsequent issue pertains to structural unemployment. The phenomenon of structural unemployment can be attributed to a discrepancy between the competencies and certifications possessed by prospective employees and the competencies required for the available employment opportunities. This discrepancy is frequently attributable to economic fluctuations, such as those occasioned by technological advancements or shifts in consumer preferences, which result in the obsolescence or diminished demand of specific skill sets. To illustrate the point, consider the decline of the typewriter industry with the advent of computers. Individuals skilled in the use of typewriters, who were highly proficient in their operation, may have encountered a decline in employment opportunities, as the demand for the particular skill set, which entailed efficient utilization of the typewriter, diminished in response to technological advancements. The superior efficiency and accessibility of computers, in comparison to typewriters, resulted in the former being utilized for domestic tasks. An additional illustration of this phenomenon can be observed in the decline of manufacturing jobs in specific regions. As manufacturing processes underwent increased automation, there was potential for companies to require a reduced workforce on the factory floor. This can result in structural unemployment, as individuals possessing specific skills in manual assembly or machine operations encounter difficulties in securing relevant employment. In the contemporary context, accelerated progress in the fields of artificial intelligence and automation has the potential to result in the emergence of structural employment opportunities for specific administrative roles that are susceptible to automation. It is evident that the utilization of artificial intelligence, AI, in tasks such as data entry and customer service is a prevailing trend in contemporary employment. This development, despite its current limitations, has the potential to render traditional job roles redundant. The phenomenon of structural unemployment serves to emphasize the significance of ongoing skill development and adaptability in response to evolving employment market conditions. In the context of a constantly evolving economic landscape, it is imperative for individuals to develop and acquire new skills in order to maintain competitiveness and mitigate the impact of structural shifts in the economy. Finally, the concept of frictional unemployment is introduced. Frictional unemployment is hypothesized to be the predominant form of unemployment experienced by the general population. This phenomenon manifests during periods of transition between employment opportunities or the initial entry into the workforce. This phenomenon is an inherent and inevitable component of a dynamic job market, where individuals are perpetually engaged in the pursuit of superior employment opportunities that offer higher remuneration and enhanced benefits, while employers, in turn, are actively seeking candidates who possess the requisite qualifications and experience to fulfill their organizational needs. To provide a concrete example, one may consider the experience of a recent college graduate who is entering the job market. It is possible that the subjects may encounter frictional unemployment as they seek their initial full-time position. During this period, individuals are seeking employment that is commensurate with their skill set, interests, vocational objectives, remuneration, and, potentially, proximity to their place of residence. The process of seeking employment, applying for positions, undergoing interviews, and negotiating terms can be time-consuming and may result in temporary unemployment, which is referred to as frictional unemployment. Another example of this phenomenon is when an individual voluntarily leaves a job to pursue a new opportunity. It is acknowledged that a period of frictional unemployment may be experienced by individuals during the transition from one employment position to the next. It is often the case that such a discrepancy is a necessary component in order to facilitate the logistics of transition, including such activities as the relocation of assets or the completion of requisite documentation. Whilst frictional unemployment is an inevitable phenomenon, it can be mitigated through the implementation of effective job search strategies, networking, and the utilization of online job platforms. It is important to note that frictional unemployment is generally considered to be a healthy aspect of a dynamic job market. This is because it reflects the individual's ability to move and their flexibility in pursuing opportunities that best fit their skill sets and aspirations. The issue of inflation is therefore pertinent. As was established in the preceding module, the value of money is subject to alteration over time, a fact that must be taken into account when calculating gross domestic product, GDP. The purchasing power of money is subject to change over time. Consequently, gross domestic product, GDP, figures, when not adjusted for inflation, might demonstrate consistent growth. However, in reality, it is conceivable that the real GDP, understood as the GDP with the time value of money taken into account, could be in a state of decline. The calculation of real GDP is achieved by deducting the impact of inflation from nominal GDP, i.e., the value that would be reported. It is imperative to ascertain which entities are exerting influence on macroeconomy. It is evident that the two primary actors responsible for the governance of this system are the governments and central banks of the respective nations, who are entrusted with the implementation and development of relevant policies. Consequently, companies and consumers are impacted by these changes and must adapt accordingly. It is evident that governments are responsible for the implementation of fiscal policy, while the role of banks is to implement monetary policy. The following discussion will firstly explore the definition of monetary policy. Monetary policy constitutes the mechanism by which a nation's financial institutions oversee the supply of money and the associated interest rates, with the objective of exerting influence on the overall economic activity. It is evident that by making adjustments to interest rates and utilizing instruments such as open market operations, central banks are capable of exerting control over inflation, promoting borrowing and spending during periods of economic stagnation through the implementation of expansionary monetary policy, or alternatively, effecting a contractionary monetary policy to temper an overheating economy. Expansionary monetary policy is defined as a strategy employed by central banks to stimulate economic growth through the reduction of interest rates, thereby facilitating access to financial resources for consumers. The rationale behind this phenomenon is that the interest that would be required to be paid by the borrower on a loan is reduced, thus rendering the loan much more appealing. Monetary policy that is contractionary in nature involves central banks increasing interest rates, thereby rendering borrowing more costly. This, in turn, leads to borrowers incurring greater interest expenses, thereby diminishing the allure of these loans. Japan's utilization of interest rates as a means of economic stimulation offers a noteworthy illustration of the operational dynamics of monetary policy. In the context of an expansionary monetary policy, a decline in interest rates from 3% to 2%, for instance, could be a policy measure employed to stimulate borrowing. Japan, however, opted for an unconventional approach. The Bank of Japan established an interest rate of negative 0.1. This is a highly distinctive measure that has been implemented by Japan's government to address its particular requirements. This was an attempt to address the issue of deflation, which was a significant problem in Japan at the time. The implementation of negative interest rates has been demonstrated to have the effect of rendering it more financially advantageous to borrow and expend money than to simply retain it. Consequently, individuals persisted in incurring debt due to the financial incentives provided by the loans. This, in turn, led to increased expenditure, thereby providing a stimulant effect on Japan's economy. The subsequent discussion will address the matter of fiscal policy. Fiscal policy constitutes the means by which governments utilize taxes and public expenditure in order to exert influence on the domestic economy. In the event of economic downturns, governments may implement expansionary fiscal policy, which involves the adjustment of tax rates and government spending levels, with a view to stimulating economic growth. Conversely, in periods of high growth, contractionary fiscal policy may be employed, with the aim of controlling inflation. It is evident that expansionary fiscal policy, akin to expansionary monetary policy, entails governments allocating greater financial resources to augment the circulation of money within the circular flow of income. This dynamic process has the capacity to generate employment opportunities and stimulate economic growth. The term, contractor fiscal policy, refers to the practice of government increasing interest rates with a view to decreasing the disposable income of the general public, thereby reducing their spending. As a case in point, the manner in which governments can allocate financial resources may be illustrated by reference to three distinct categories: military expenditures, infrastructural investments, and social programs. The former two categories are commonly regarded as means of stimulating the economy, and may therefore be termed injections. The manner in which they are able to exert influence over tax rates is through the implementation of increases or decreases in corporate tax, as well as increases or decreases in individual tax, such as income tax. As previously stated, fiscal policy can be categorized as either expansionary or contractionary, depending on whether the objective is to promote spending or to reduce it, respectively. It is evident that monetary policy, which is subject to the influence of the central bank, is characterized by a greater degree of expediency in comparison to fiscal policy. The process of controlling interest rates is considerably more expeditious than that of initiating infrastructural projects, which can require a considerable time period before the observed outcomes manifest. It is evident that interest rates have a direct impact on the circulation of money, and consequently, their influence is felt with greater rapidity. In the realm of infrastructure projects, the advantages are manifest in the augmentation of employment opportunities and the influx of capital into the economy, manifesting in the form of available buildings that serve as strategic locations for corporate relocation. The identification of suitable locations for relocation by companies is often a time-consuming process. Furthermore, the immediate augmentation of the economy as a consequence of employment is not a phenomenon that can be immediately observed. In this section, the focus will be on ESG, an acronym which stands for environmental, social, and governance. ESG has become a topic of much concern in recent years, but it has existed for hundreds of years, and even longer than that. ESG is defined as the social mission of a company, and the process of integrating social aspects and objectives within a company's goals. Nevertheless, there is an increasing demand for environmental, social and governance, ESG, considerations in the investment process from investors and stakeholders alike. Nevertheless, there is a considerable degree of skepticism surrounding the role of ESG and responsible investing. The notion that an emphasis on environmental, social and governance, ESG, factors inevitably results in diminished financial returns is a contentious one. However, this is not the case. In this section, the following topics will be explored. Firstly, the definition of ESG. Secondly, the importance of ESG. And thirdly, the manner in which investors can utilize ESG to advance social goals whilst ensuring that their portfolios are profitable. The following discussion will firstly address the question of what ESG actually is. ESG, an acronym which stands for environmental, social, and governance, is a comprehensive framework that evaluates a company's performance and practices in three key areas. The environmental aspect of a company's operations encompasses a wide range of factors, including its approach to carbon emissions, the management of resources, the mitigation of waste and pollution, and other related environmental concerns. The social aspect of a company's operations encompasses the manner in which it engages with its employees, fosters diversity and inclusion, and engages with local communities through initiatives and philanthropic endeavors, as well as its commitment to corporate social responsibility, CSR. In conclusion, the governance aspect is concerned with the internal structure of a company, its ethical standards, and its accountability. This encompasses a wide range of elements, from the composition of the board of directors to the assurance of transparency, integrity, and adherence to regulations. ESG is not merely a passing trend. This is a strategic approach which considers the broader impact of business activities on the environment, society, and ethical practices. The following discourse will thus address the genesis of ESG. ESG has become increasingly prominent among individuals outside the investment sector in recent years, yet its existence is deeply rooted and historically extensive. The genesis of ESG can be traced back to the mid-20th century, a period which saw the commencement of discourse surrounding corporate social responsibility. Nonetheless, it was not until the 1960s and 1970s, when social movements advocating for civil rights were at their zenith, that awareness of corporate impacts began to be raised. The present era is characterized by the advent of ethical investing, whereby investors proactively exclude industries that are in direct conflict with their own moral values. The necessity for responsible business practices has been further emphasized by global crises, including environmental disasters and financial meltdowns. In 2006, the United Nations took a significant step by launching the Principles for Responsible Investment, PRI, thereby signaling a formal commitment to integrating ESG considerations into investment decisions at the present time. It is evident that these historical milestones collectively paved the way for the development and widespread adoption of the ESG framework that is recognized in the present day. Okay, so the importance of ESG. The significance of ESG lies in its potential to provide businesses with a framework for achieving long-term sustainability and success. The integration of environmental, social, and governance factors has been demonstrated to engender a dual benefit for companies. Firstly, it has been shown to reduce their environmental footprint. Secondly, it has been demonstrated to foster innovation and adapt to changing landscapes. ESG practices are not merely about undertaking beneficial actions, they're also about effectively managing risks. The identification of potential environmental and social vulnerabilities has been demonstrated to offer a company a degree of protection against future disruptions. Furthermore, the implementation of a robust ESG strategy has been demonstrated to enhance a company's reputation, thereby fostering greater credibility and trust among its stakeholders. This is of particular significance in the current era, in which consumers and investors are demanding more than simply financial returns. ESG practices, in addition to their role in shaping corporate reputation, have been shown to facilitate regulatory compliance as standards within this field continue to evolve. This contributes to the demonstration of commitment on the part of the organization to ethical conduct and transparency. In essence, ESG is a concept that extends beyond the confines of a mere buzzword. It is an irrefutable strategic imperative that businesses not only thrive, but also contribute positively to the world around them. The following discussion will therefore consider the matter from the standpoint of modern investment theory. ESG has caused a paradigm shift in the investment landscape by introducing a responsible approach to decision-making. It is evident that investors are now incorporating environmental, social and governance, ESG, considerations into the strategic management of their investment portfolios. This shift in investment strategy is indicative of a growing commitment to ethical and sustainable values. Nevertheless, the issue at hand extends beyond the realm of values. It encompasses the potential financial advantages. ESG integration has been shown to offer the potential for enhanced risk-adjusted returns. This is due to the fact that companies with robust ESG practices frequently exhibit resilience when confronted with uncertainty. ESG-aligned companies also appeal to investors with a long-term outlook, as they prioritize sustainability in both environmental and self-sustainability terms. Furthermore, they are better equipped to withstand market fluctuations. It is worthy of note that research findings suggest that companies which demonstrate excellence in the field of ESG can achieve financial outperformance relative to their industry peers. ESG extends beyond the pursuit of profit, unveiling avenues for impact investing. Impact investing entails investors proactively contributing to positive societal and environmental transformations through their investment decisions. The integration of ESG factors signifies a paradigm shift in the manner in which investors conceptualize value, with a concomitant emphasis on both financial returns and contributions to a more sustainable world. This is of particular significance in the contemporary era. In the contemporary business environment, environmental, social and governance, ESG, factors have assumed an increasingly pivotal role. Companies that do not incorporate ESG principles into their practices are subject to heightened scrutiny, as evidenced by subsequent case studies. In contrast, organizations that have adopted ESG standards are perceived as more accountable and transparent, and as a result, face less intense scrutiny. The repercussions of environmental, social and governance, ESG, considerations extend beyond the confines of a company's internal operations, permeating the realm of its stakeholder relationships. It has been demonstrated that employees exhibit increased levels of engagement and satisfaction when employed by an organization that prioritizes their well-being and fosters a positive workplace culture through the implementation of ESG practices. It has been demonstrated that consumers are drawn to brands that align with their own values, and ESG provides that connection. It has been demonstrated that companies which prioritize strong environmental, social and governance values tend to attract and retain a customer base, which is socially conscious. This, in turn, has been shown to result in a strengthening of brand loyalty. ESG initiatives have been demonstrated to have a positive ripple effect beyond employees and customers, contributing to societal well-being and forging deeper community connections. Smith, 2023. It is evident that investors and other stakeholders also anticipate transparency and ethical conduct, thus rendering environmental, social and governance, ESG, factors an indispensable component in establishing trust. In essence, effective ESG practices encompass the management of a company's reputation, as well as its relationship with the broader ecosystem within which it operates. The global impact of ESG. As previously stated, ESG is not confined to companies or communities. It also has a substantial effect on global outreach. The prioritization of environmental sustainability is congruent with global objectives, including the mitigation of climate change and the conservation of biodiversity. From a social perspective, ESG initiatives address critical issues such as poverty and inequality, thereby contributing to a more comprehensive global development agenda. Evidence of the collaborative nature of ESG is apparent in the establishment of partnerships between companies, governments and organizations on a cross-border basis. These partnerships are formed with the aim of addressing challenges that are shared by all participants. ESG has been shown to have a positive effect on companies, encouraging them to innovate in a sustainable way, develop solutions that can drive positive impacts on a global scale, and innovate to a greater extent. Consequently, the question arises as to how financial investors should approach the assessment of a business's environmental, social and governance, ESG, performance. Having established the importance of ESG, the subsequent question pertains to the methodology of measurement. The evaluation of a corporation's environmental, social, and governance, ESG, performance entails a comprehensive assessment of its practices across these three key dimensions. ESG rating agencies are of pivotal significance, as they provide scores based on well-established criteria that measure companies' alignment with ESG practices. In certain industries, there exist explicit ESG standards that establish expectations regarding the manner in which companies should operate in a sustainable manner. As is evident on the screen, there is an entity known as the MSCI ESG rating, which is one of the ESG rating agencies. Furthermore, transparency is imperative, as companies disclose their environmental, social and governance, ESG, data through reports that reveal their efforts and impacts. A critical aspect of consideration is materiality, which is defined as the process of focusing on the ESG factors that are most relevant to a company and its industry. This approach ensures that efforts are targeted in the most effective manner. ESG assessments have been shown to serve as a dynamic tool for companies, enabling them not only to measure their current performance, but also to identify areas for growth and enhancement. Smith, 2023. The following discussion will explore the manner in which businesses can incorporate ESG. The integration of environmental, social and governance, ESG, considerations into business operations necessitates a nuanced and comprehensive approach. The process is initiated by the presence of robust leadership, characterized by the proactive advocacy of environmental, social and governance, ESG, principles from the highest levels of management. It is not sufficient for this to be considered an afterthought. Rather, it is imperative that it is integrated into the core business strategy, in conjunction with the business principles and the business plan, which were discussed earlier. Stakeholder engagement is of critical importance. It is imperative that employees, customers and partners are engaged in ensuring that environmental, social and governance (ESG) initiatives are aligned with their needs and concerns. In order to measure progress, it is first necessary to establish clear ESG metrics and targets, or alternatively to consult ESG agencies. This approach assists in ensuring that companies are held responsible for their endeavors. Moreover, it is imperative to raise awareness among employees to ensure they comprehend the significance of ESG, their role in its implementation, and the implications thereof. It is evident that innovation flourishes in environments where environmental, social and governance (ESG) objectives are aligned. Consequently, it is incumbent upon companies to foster research and development initiatives that are conducive to sustainability. The following discussion will therefore consider the relative merits of ESG versus non-ESG stocks. Despite the evident advantages of ESG, it is imperative to ascertain its practical benefits. Theory is not always correct. The following discussion will consider the issue from a realistic perspective. The decision between ESG and non-ESG stocks has had considerable ramifications for investors. As previously stated, companies with a strategic alignment with the principles of environmental, social and governance (ESG) investment tend to exhibit superior risk management capabilities and demonstrate greater resilience in the face of market turbulence. A substantial body of research suggests that, over an extended period, ESG stocks have the potential to demonstrate superior performance in comparison to their non-ESG counterparts. This phenomenon can be attributed to the adoption of sustainable practices and the implementation of responsible strategies. Furthermore, as the demand for ethical and sustainable investments grows, particularly in the modern world, there is a possibility that ESG stocks could experience heightened investor interest. ESG-aligned companies may also encounter fewer regulatory impediments and reputational risks, rendering them potentially more stable options. For instance, they may not be subject to the legislation that governs the imposition of carbon taxes, and they may not be required to adhere to quotas that most companies that are not focused on environmental, social and governance (ESG) issues may find challenging to meet. Investment in ESG stocks represents an alignment with broader trends in responsible investing and sustainable consumer behavior, extending beyond the scope of financial gains. In order to facilitate comprehension, a hypothetical scenario will be examined, with two companies being compared, one that adheres to ESG practices and one that does not. The company that is responsible for the production of renewable energy has a robust record of reducing carbon emissions and promoting clear energy. Consequently, there has been a consistent increase in the sector, which can be attributed to an escalating demand for renewable energy sources and favorable regulatory policies that may result in a reduction in taxes or the provision of subsidies. Furthermore, the integration of positive media exposure has been demonstrated to yield a concomitant enhancement of corporate reputation and market valuation. Conversely, a corporation that depends on fossil fuels is likely to be the subject of criticism regarding its ecological impact and its adverse media presence, attributable to its contributions to climate change. Consequently, the company's stock is anticipated to exhibit volatility in response to the volatility of oil prices within a dynamic market, thereby altering market dynamics. This is further compounded by mounting concerns regarding environmental sustainability. In light of the aforementioned evidence, it is evident that the prior case constitutes a superior option in this particular scenario, particularly with regard to the utilization of renewable energy sources. Furthermore, an additional example should be examined, with the focus this time being on the social and governance aspects. In the contemporary business environment, there is a growing body of evidence to suggest that companies which promote gender and ethnic diversity in their workforce are more likely to achieve commercial success than those which do not implement such practices. The rationale behind this phenomenon is that employees are more likely to be motivated in the workplace when companies demonstrate a commitment to diversity. Furthermore, media outlets are more likely to portray companies that prioritize diversity in a favorable light, while those that do not demonstrate such a focus are more likely to be subject to criticism. However, this is a nuanced approach. It is imperative to confront the prevailing circumstances with a sense of urgency and clarity. In certain instances, enterprises that do not currently adhere to environmental, social and governance (ESG) principles may, in the short term, demonstrate superior performance in comparison to those that do. However, it is important to note that as the world becomes increasingly focused on social objectives, the importance of ESG will increase. Consequently, non-ESG companies that are currently in a stronger position may not be in the same position in the future. In this section, the following topics will be covered: the construction of a portfolio and diversification, types of management, and the fundamentals of portfolio construction. The concept of diversification is first defined. Diversification can be defined as the process of acquiring assets from multiple asset classes with a view to expanding the number and variety of securities in one's portfolio. As illustrated in the diagram, the x-axis represents a series of securities, while the y-axis denotes the standard deviation of a given portfolio's returns. The height of the curve represents the total risk, and as the number of securities in one's portfolio increases, the amount of unsystematic risk decreases. However, a systematic risk persists, and this will be discussed in more detail shortly. In essence, the act of acquiring additional securities signifies an approach that is not predicated upon the placement of all assets within a singular investment category. As the investor diversifies by selecting companies from disparate sectors and industries, the portfolio becomes resilient to the failure of any individual component, thereby mitigating the risk of a complete portfolio collapse. Empirical evidence indicates that a minimum of 30 to 40 different securities are required to achieve a fully diversified portfolio. It is imperative to first establish the types of risk involved. It is important to distinguish between systematic and unsystematic risk. Systematic risk is defined as a market risk, which is non-diversifiable. This means that it can be eliminated through diversification, and it originates from market-wide risks. Unsystematic risks, by contrast, are risks that are specific to a given company or industry and which are inherent to a particular investment. Systematic risks are non-diversifiable, meaning they cannot be eliminated. This risk persists even after measures have been implemented to diversify a portfolio. Systematic risk is defined as the risk of loss resulting from broader economic or financial developments, including but not limited to fluctuations in interest rates, inflation, recessions, and wars. Shifts in these variables have the capacity to exert influence on the market in its entirety. Therefore, they cannot be mitigated by adjusting the composition of a portfolio of equities. This is due to the fact that such shifts have an effect on each individual Euro's equity. To illustrate this point, the global financial crisis is a prime example of systemic risk. Investors who entered the market in 2008 witnessed a substantial alteration in the valuation of their assets as a consequence of this economic occurrence. The Great Recession had a differential impact on different asset classes. Riskier securities, which were typically leveraged more, were sold in large quantities, whereas simpler assets, such as treasury bonds, experienced an increase in value. Unsystematic risk is defined as a company or industry-specific risk that is inherent to each investment. The diversification of investments has been demonstrated to reduce other systematic risks, see Figure 1. Systematic risks encompass a range of potential hazards, including but not limited to inflation risk, interest rate risk, exchange rate risk, and external shocks such as pandemics and war. Net risks are defined as the specific financial risks to which particular companies are vulnerable. These risks may include business risk, financial risk, default risk, and liquidity risk. The question therefore arises as to how the performance of a portfolio might be measured. The most effective approach to this undertaking is to utilize benchmarks. A benchmark is defined as a standard tool or measure that can be utilized to analyze the risk of a gear and portfolio. It is a well-established practice for individual funds and investment portfolios to have an established benchmark that can be used for standard analysis to check the level of risk. The distinction between time-weighted and dollar-weighted returns. Time-weighted returns are determined without regard to any subsequent cash flows from the investor. The primary objective of the measurement is to evaluate the performance of the investment over a specified time period, as opposed to focusing on the returns of the investor. The returns quoted by mutual funds and other investment managers are time-weighted, given that the portfolio manager is unable to exercise control over the future cash flows of investor dollars. By way of contrast, a dollar-weighted return is defined as the subsequent consideration of contributions to and withdrawals from an investment. For instance, it takes into account the temporal aspects of sales and the utilization of purchases. The dollar-weighted approach is predicated on the premise that the returns of the investor are of primary importance over a given period of time. It is a well-established fact that this will generally differ from the time-weighted return. The following discussion will therefore explore the means by which portfolio risk is measured. In order to measure risk, it is first necessary to define the concept of risk itself. As previously stated, risk is defined as the probability of a stock underperforming, or the risk of volatility. The measurement of risk is achieved by evaluating the probability of the performance of a portfolio deviating from the returns of the market or the benchmark portfolio. The most efficacious method of calculating risk is to employ the standard deviation metric, which furnishes returns over a specified time period. Standard deviation is the measure of dispersion of a set of data from its mean. The absolute variability of a distribution is measured by this process. In essence, the greater the standard deviation, the greater the deviation from the mean. The following formula is employed to calculate standard deviation. Should any of you have previously undertaken a course in statistics, you will doubtless be able to comprehend this subject. Nevertheless, it is not obligatory for one to comprehend the methodology of calculating standard deviation in order to utilize it. It is possible to utilize any online calculator in order to ascertain the precise figure. The following figure illustrates a standard deviation belt curve. In essence, the regions encompassed by the curve are deemed to be more conducive to favorable outcomes, signifying a heightened probability of success. In this particular domain, it has been observed that 68.27% of opportunities will adhere to this pattern. However, as extremes are approached, the number of situations falling under the umbrella will increase. However, the rate of change is declining. The following discussion will compare and contrast active and passive management strategies. Passive investment strategies are designed to replicate the composition, weights, and risk and return profile of a particular benchmark or index of securities. The strategy under discussion is predicated on a buy and hold approach, eschewing the identification of winners and losers among the securities in question. Instead, the strategy is to hold the securities in question and observe the subsequent development of events. The merits of passive management are manifold. Chief amongst these is the financial advantage of low fees, which is further enhanced by the increased tax efficiency that results from low portfolio turnover. In addition, the limited infrastructure required for portfolio management is a significant benefit, as it makes the process of management more straightforward. The most prevalent applications of vehicles in the context of passive investment encompass index mutual funds and exchange-traded funds, ETFs. Active management, in contrast, is predicated on the premise that risk-adjusted returns that surpass the benchmark can be attained through the selection of securities, the implementation of market timing strategies, and the execution of sector rotations by portfolio managers who are highly skilled and professional. The process of selecting specific stocks is predicated on the assumption that an informed decision can be made regarding the anticipated performance of said stocks. It is an established academic fact that actively managed investment portfolios typically result in significant portfolio turnover. This is due to the fact that the manager reacts to market trends, whether these are observed or forecasted, which are temporary in nature. The high turnover of assets in a portfolio necessitates the allocation of considerable resources to the training and supervision of staff, as well as the management team. Consequently, the manager is compelled to impose substantially higher fees than would be applicable to a passively managed portfolio. This phenomenon often leads to suboptimal tax efficiency, as the frequent transactions in securities can result in the imposition of capital gains tax, which is a tax levied on the profit made from the sale of stocks. The capital gains tax liability is increased for transactions involving the sale of a stock within a period of less than a year, and is decreased for transactions involving the sale of a stock that has been held for more than a year. Historically, the S&P 500 has demonstrated a higher degree of success in comparison to actively traded portfolios. This phenomenon has been observed over the past 2 decades, and a replicable index can be constructed. For instance, one could purchase all 500 stocks that comprise the S&P 500 index in equal proportion. Nevertheless, the problem with that is that one would be required to constantly monitor the investments and buy and sell at the weights of these companies on the index. It has been observed that certain prominent institutional investors, such as pension funds, engage in this practice. However, it is less feasible for individual investors, as is the case for most people. A more thorough examination of the S&P 500 reveals that, in comparison to the Russell 2000, the former becomes even more impractical. In the context of financial instruments, 2 options are available for consideration: index mutual funds and index ETFs. These instruments bear a resemblance to mutual funds, yet they are distinguished by the continuous trading throughout the day, akin to the trading of stocks. However, it is not advisable to adhere exclusively to either a passive or active investment strategy. A more efficacious approach would be to implement a hybrid management strategy that incorporates both index and active stocks. The present study will examine the case of Yale. Yale, with its fixed income, had an in-house team responsible for the acquisition of securities. Furthermore, the organization purchased a number of fixed and active assets with the objective of generating revenue. It has been observed that, in recent times and with a view to the past, there has been a notable increase in the number of instances in which the performance of active managers has outpaced that of the S&P 500. For instance, Peter Lynch achieved a 29% return on investment at Magellan Fund from 1977 to 1990, including dividends. Furthermore, he outperformed the S&P 500 by more than 13% per annum during that period. However, it is evident that his investment strategy proved to be highly profitable during this period. Despite the fact that certain individuals may have lauded him, it is possible to a certain extent to attribute his accomplishments to good fortune. Despite the fact that he did purchase high-quality companies that were trading at a reasonable price, he was unable to do so for a consistent period of time. This is in contrast to the strategy of investing in the S&P 500 over a longer period of time, which would have allowed for such consistency. It has been demonstrated that certain stock pickers are capable of outperforming funds such as the S&P 500. However, it would be erroneous to infer that this success will continue into the future. Consequently, it is imperative to diversify one's investment portfolio by incorporating both passive and active funds, with the passive funds being those which require minimal management. In this concise section, following a comprehensive discussion on financial investments, the focus will now shift to alternative investments. Throughout this course, the following topics have been covered: equities, fixed income securities, corporate strategy, the economy, and financial documentation. However, a plethora of investment opportunities exists beyond the conventional stocks and bonds, which many individuals perceive as the sole viable investment prospects. As a businessperson and as an individual, you will encounter opportunities to invest in non-conventional investments. Examples of such assets include real estate, equipment leasing, hedge funds and, more recently, cryptocurrencies and NFTs. It is imperative to acknowledge the viability of these investment opportunities, despite their infrequent utilization in comparison to conventional financial instruments such as stocks and bonds. The utilization of alternative investments, including those discussed herein, has the capacity to yield returns and profits, provided that they are invested in an appropriate manner. The purpose of this section is to provide a concise overview of alternative investments and the distinguishing characteristics. It is evident that a broad spectrum of investment instruments has been observed, encompassing equity, private equity, and venture capital, among others. Private equity can be defined as the acquisition of shares in a company, whereas venture capital refers to capital that is raised by individuals who possess the necessary financial resources to invest in business enterprises. Nonetheless, alternative investments encompass a broad spectrum of financial instruments, including real estate investments, which may involve the acquisition of land or property. Equipment leasing can be defined as the process of renting equipment for a business, with the objective of generating revenue during periods of equipment inactivity. Hedge funds, on the other hand, are a more complex financial instrument, although they bear similarities to investing in a group of stocks, commodities or precious metals. Indeed, there is the possibility of investment in a variety of assets, including lithium, aluminum, cryptocurrencies and collectibles. Examples of such phenomena include Bitcoin, Ethereum, and non-fungible tokens, NFTs. The following discussion will explore the characteristics of alternative investments. To illustrate this point, one need only consider the liquidity of real estate assets. It is evident that illiquidity has a direct impact on risk, which is an important consideration in financial analysis. However, it should be noted that this is subject to variation from one investment to another. Furthermore, these instruments are predominantly marketed by financial advisors or broker-dealers, with the primary target demographic being accredited investors. Consequently, they are less readily available and less straightforward to invest in when compared to stocks and bonds. Furthermore, these assets are categorized as either public or private. However, they are seldom traded publicly on the stock market in the same manner as stocks. It is important to note that such investments are characterized by a high level of risk and, consequently, the potential for high returns. It is reasonable to hypothesize that a sharp increase in value is probable, in a manner analogous to the surge in value experienced by cryptocurrency. However, there is also a high probability of loss, which would result in significant financial losses. It is imperative that investors in alternative investments, particularly those with limited expertise in the relevant field, ensure that they make an informed decision and proceed with caution in order to avoid missing out on lucrative opportunities. It is now time to conclude this course. In summary, the following points will be addressed. It has been established that the time value of money, the accrual of compound interest through mortgages, the identification of favorable investments, and the significance of capital markets in the context of environmental, social, and governance, ESG, criteria are all pertinent to commercial enterprises. In addition, the business cycle, fiscal policy and monetary policy have been thoroughly explored, with case studies of Japan being analyzed in order to facilitate comprehension of the fundamental principles of economics. In the field of finance, an extensive review of pertinent documentation has been conducted, encompassing strategies for portfolio diversification, risk mitigation, and foundational statistical principles. It is evident throughout this course that these three disciplines are interconnected in a complex and interdependent manner. Consequently, studying one of these disciplines without a fundamental grasp of the underlying principles of at least some of the others is an unfeasible endeavor. It is appropriate to extend congratulations to all those who have successfully completed this stage of the program. It is to be hoped that the knowledge acquired will prove beneficial as the participants progress to the next stage of their studies, at which point they will have the opportunity to explore the subject in greater depth. It is imperative to reiterate that I am the proprietor of a YouTube channel, entitled Changemakers Media, as can be verified in the comments section. The purpose of this publication is to showcase the positive contributions made by young people to their local and international communities. In order to achieve this objective, videos are posted which highlight the activities of these young people. It would be greatly appreciated if you considered subscribing to demonstrate support for these adolescents and to encourage them to continue making a positive impact on the world. I hereby conclude my remarks. I would like to express my sincere gratitude to all those who have attended today's event. I hope to see you again in the future. Thank you for your attention.